Hi everyone, this is Madhu with FinTrainers. So today we are going to be looking at CMA part 2 and one of the topics from the first section, the financial statement analysis. Topic 3 is profitability analysis there. And specifically today we are going to be looking at asset turnover ratios and the implications of that when we are analyzing profitability and ability to generate revenue for companies, right? So CMA exams are coming up soon for some of you. So this is more of a helpful quick tip on how to understand ratios and how to think about the implication of the ratios. So let's look at it. So the first thing we're going to talk about is the asset turnover ratio, right? So when we are thinking about a company A that has, let's assume, $100 in assets and is generating a net sale of $100 in that year. So the average assets that the company had throughout the year was $100 and it was generating $100. So for each dollar of assets, the company was able to produce a dollar in revenue. So if I divide the revenue by the asset, so I get this one as the ratio or the turnover ratio, total net sales divided by average total assets for that year. Now let's assume another company is generating a net sale of $200 with the same average assets of $100. So in that case, that company, if we use the same formula, net sales divided by average total assets, right? You're talking about the average assets for the year. So in that scenario, it's going to be 200 divided by 100. So the asset turnover ratio is going to be 2. So just comparing these two companies with just knowing the asset turnover ratios, you will know that the company B is producing twice the amount of sales for the given same amount of assets. So for each dollar of assets, company B is generating a lot more revenue, which means that they are going to be probably mostly more profitable compared to company A. Another turnover ratio that we have to know and understand is the fixed asset turnover ratio. So here, instead of the average total assets as the denominator, we are going to be using the average fixed assets. So that means it is going to be PPE, right? Plant property equipment line from the balance sheet that we'll take, and it is net PPE. So if there is any accumulated depreciation, we will subtract that. So it's a net PPE number that we will use in the denominator. So the same example, if there is $100 of revenue, but company A has a PPE, net PPE of only say $20 of assets in PPE, the ratio is going to be 100 divided by 20, so it's going to be 5 fixed asset turnover ratio. And then in the case of company B, let's say the company B had same amount, right? So like they had $200 of sales, company A had $100 of sale in our example, but they had $20 of PPE. Before they had $100 of assets, but when it comes to the average PPE, it was 20. So we are getting an fixed asset turnover ratio of 5 for company A. When it comes to company B, they were making $200. But what if I say they had a PPE of 50? So their assets were 100, but the PPE was 50. The fixed asset ratio, turnover ratio, is going to be 4. So when we are looking at fixed asset, it looks like company A is doing a better job of generating revenue for each dollar of fixed assets. So what it could mean is that company A might be having less of intangible assets, goodwill, and maybe less current assets. So when it comes to manufacturing companies, one of the key things is the fixed assets, because that is the net block, fixed asset block that they're going to be using to generate revenue, and it is a very meaningful metric. It might not be meaningful in some industries like services, IT, SaaS, where they probably are not using a lot of fixed assets, right? So it depends on the industry. In the case of most of the manufacturing industries, if you're comparing companies, industries within the same industry, then it is a pretty good measure of using it for profitability analysis, even compared to asset turnover ratio, because you're eliminating a lot of the noise related to goodwill or even current assets, marketable securities, all of those. So let's look at one more detailed example here. I have done analysis between Intel and NVIDIA. So just going to open up my Excel here. So let's go into the Excel and look at detailed analysis between Intel and NVIDIA. So Intel's data I took from the 10K and 2020 and 2021. Same thing for NVIDIA as well. So just we will look at Intel's to understand how to get the data. Let's go to the 10K here. So you can see this is the balance sheet. So we have the assets for 2 periods. It's a comparative balance sheet. So December 25, 2021, 168,406 million, and for December 26,000 as well. So if we go back here, so you will see we have taken the values exactly as in the balance sheet. And then for the sales, we have to get the net sales number. So for that, we will have to be going to the income statement. There we go. So for the year of 2021, it is 79,024. They have already given the net revenue, that is revenue minus any commissions, discounts, etc. So we have those values here. Same thing for fixed assets. So fixed assets, we'll have to go back to the balance sheet. We'll have to go to the PPE line. So as I said, this is not the gross PPE, but the net one. So PPE, and you take that and subtract any accumulated depreciation. But in this case, Intel has already given us the net number. So that's wonderful. So we just take those, plug it in as well. So after that, we'll go about calculating the average assets, because so these are point in time balance sheet values of assets. This revenue of 79,024 million was created not with 168,000 in assets, but somewhere in between, because the starting point was this asset and the ending point was this. So we are taking an average. So might add those two and divide it by 2. You get that value. Same thing we do for fixed assets. So the asset turnover ratio is just subtracting the net sales, dividing the net sales over the assets here, the average assets. So net sales divided by average assets. So that comes to 0.49. So it's not, doesn't look like a great number, but certain industries can be like that. So let's see how NVIDIA compares to Intel. Fixed asset turnover, on the other hand, we will use the average fixed assets. So the fixed assets are roughly what, 35-40% of the assets. So the fixed asset turnover obviously is going to be higher because we have removed out current assets, any goodwill and all of that. So that comes to 1.32. So now when we look at NVIDIA on this side, so these values have taken from their 10K. Similar calculation, you can see that asset turnover for NVIDIA is a little bit higher, so but not very compelling. So in the prior example that we saw, right, like A and B companies as a hypothetical example, even though the asset turnover was higher for B, the fixed asset turnover actually was higher for A. So let's see if that is the scenario here for Intel and NVIDIA. Unfortunately, that's not the case here. Intel's fixed asset turnover was 1.32, whereas NVIDIA is almost 11 times, more than 10 times, right? So 26,000 billion in sales, right? With just 2,464 million of fixed assets, so more than 10 times. So they're generating $10.93 for every dollar of fixed assets. That is just blowing Intel out of the water there, right? So clearly NVIDIA is using their assets better to generate revenue. So if you have any doubts or questions, leave a comment below. We will be happy to answer those. All the very best for your CMA preparation.